Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, Norado Real Estate, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Hey, welcome in to Get Rich Education. I'm your host, Keith Weinhold, and I'm so glad that you're here for episode 197. It is a household name, just like Kleenex, Coke, and WD-40. I'm talking about the 401k retirement savings plan. The inventor of the 401k is here with us today. He'll be joining us shortly. I don't like the 401k and similar defined contribution plans, and I'm going to tell you why. But first, let me tell you that when I used to work for an employer in those early years of working at a job, I did contribute to a 401k. I even had one maxed out for a few years. I am telling you now that I do hereby repent. I would like to come clean for this unspeakable financial atrocity and totally blasphemous transgression. Even after I started investing in real estate, I still participated in a 401k for a little while longer until I began to realize that I just can't withstand the opportunity cost any longer. I started to realize the opportunities lost there. You know, I probably held on because I was still partly under the gravitational pull of social convention while I was still piecing together the fact that real estate investing pays you 5 ways simultaneously and in a durable way. Well, now, especially if you're a new listener, you might wonder, well, what's wrong with a 401k? Isn't it smart to plan for my long-term financial future? And plus, I get all those tax benefits along the way, right? Well, sure, it is smart to plan for your long-term financial future. But with the 401k, you do that at the expense of your present and at the expense of your short-term future and at the expense of your intermediate-term future. And why is that? Well, of course, it's because contributing to a 401k takes dollars out of your pocket today. It reduces your salary now when you're 25 or 35 or 45 or 55. And you cannot receive penalty-free distributions. You don't get any money out until just starting between age 59 and a half and 70 and a half, at which time you must begin paying tax on them. So therefore, you are deferring your life. Yeah, okay, but some people will still hang in there and say, hey, I'm getting a net benefit because I'm deferring my tax, plus my returns compound and grow tax-free in this 401k for decades until at which time I can pay a lower tax rate down the road. Oh my gosh, you just can't beat that. You know, that's what some people think. Well, this life deferral crowd, they go on to say, I would have had to pay a higher tax rate in my working years because my marginal income tax bracket is higher, but instead I get to pay a lower tax rate when I'm retired because when I'm retired, my income will be lower, so I've got this all figured out. Oh, geez. So you're planning on having your income be lower decades from now when you're retired rather than higher? So in retirement, when you have all this time to travel or play with big boy toys or, you know, whatever you want, your 401k, which you made sacrifices for during all of your working life, reducing your quality of life in your youth, which is forever irreplaceable, then that 401k will also mean that you'll adjust to a further reduced quality of life in retirement. So it's settle now and just barely survive later. Like, that's the plan? It's to sacrifice, settle, and cut. Sacrifice, settle, cut. You get so used to sacrifice, settle, cut for decades that you get trained to do even more of sacrifice, settle, cut in retirement. I guess that's the plan. That's what the life deferral crowd is doing, which also seem to be the same group of follow the herd sort of people that also belong to the debt-free crowd. Now, in their defense, those people aren't dumb. They're often unaware that there's an alternative. But, some of them won't listen to the alternative. When you've believed the same old thing for so long, plus everyone else around you is also doing it, it can be difficult to change. With 401ks, compounding interest is lame. You've got zero leverage. Subtract out inflation and emotion and taxes and fees and volatility, and you're going to be fortunate to have any real return there. And the whole time in 401ks, you're typically invested in lousy retail financial products, and they're often laden with substantial fees that often aren't so apparent. And look, although you might put 10% of your pre-tax dollars into a 401k, that might be 50% of your discretionary income that's gone, your net discretionary income after all of your recurring life expenses. That's why 10% to a 401k diminishes your quality of life a lot more than what those people are thinking. Now, if I had kept investing in a 401k, you never would have even heard my name because I'd still be working. Now, do you ever wonder what makes some people more successful than others? Yes, it's education, it's taking action and all that, sure, but it really all comes down to these tiny pivot points in your life called decisions. Small hinges open up big doors. Since 401ks reduce your salary for decades, if you stopped contributing, you obviously quit hemorrhaging income right away and you get back to equilibrium. But it can get better than that because you can pivot into a plan to now increase your salary by purchasing income property, and you're substantially better off than when you were hemorrhaging income in a 401k. Now you've put a different plan in place where you get better returns with real estate and cash flow that builds up all through your life so that you're increasing your quality of life decade after decade instead. And, really, let's look at it long term. What is the more durable investment vehicle anyway? 401ks and mutual funds have only been around for decades. Strategic real estate investing has been the most proven wealth builder for centuries or maybe even millennia. So history is not on the side of the 401k contributor either. And I'll tell you what 401ks do have on their side: Wall Street marketing, lobbying, and the fact that they've made it so easy for people to participate that they'll pull the money right from your paycheck. And when Wall Street has your money, they sure don't like to give it back. We're talking about how 401k retirement savings plans work in the United States. They're plans that the private for-profit sector utilizes, and they're pretty much the same as 403b plans, which are used largely by government organizations and nonprofits. And an American 401k plan is similar to a Canadian RRSP, or Registered Retirement Savings Plan. And there are some distinct differences between those two, but they're really quite similar because both plans were created and offered by their respective governments. Both the U.S. 401k plan and the Canadian plan give employees in the United States and Canada a tax-deferred way to invest and grow their retirement fund, and both of them have annual contribution limits. So let's talk to the very inventor of the 401k. Just imagine a man decades ago closely reading IRS tax section 398, 399, 400, and then makes a discovery in section 401, subsection K. And gosh, that sounds boring, doesn't it? I think he was working at that time, so he was getting paid for it. And even he says that he would blow up 401ks and start with something different. I'm going to ask him about exactly that eventually here. I'm also going to tell him how we invest here at Get Rich Education and see what he thinks. Let's meet today's guest. We are honored to talk to today's guest. Decades ago, he helped turn a little noticed new piece of the tax code into the least likely of really household names, the 401k savings plan. And after he helped make the discovery at his suburban Philadelphia company that subsection 401k could be used as a retirement plan, His boss had a friend in the Reagan administration that helped arrange a meeting with the right people at the IRS to help get the 401ks rolling. Yes, he is the man that is credited as the father, the inventor of the 401k savings plan. And since then, he has authored popular books like Tips for Successfully Managing Your 401k, and also one of those yellow books that are so popular in the For Dummies series called, you guessed it, 401ks for Dummies. He joins us from Pennsylvania today. Welcome to Get Rich Education, Ted Benna.
Well, thank you very much, Keith. Very kind introduction, and my pleasure to be with you today.
Ted, as I seem to remember, it was 1978 that the IRS updated the code with this piece, and you made your discovery sometime around 1980. So just confirm that timeline and then tell us about making the 401k discovery.
It actually started in 1978 with a piece of legislation, and that was the Tax Revenue Act of 1978, one of those end-of-the-year tax bills. And Congress stuck, page and a half in there, adding K under Section 401 of the Internal Revenue Code. So the key thing here for people to understand, because we all know, 401ks everywhere today. Millions of people have used it. It's politically, it's never intended. It's astounding because it's totally turned the retirement system upside down, and it's a fluke politically. It was never intended at all. So that was 1978. The effective date of that new section was January of 1980. And that date came and went, and no one was running around installing 401k plans. And that's, because it was intended for a very different reason without going into all the history. It's on my website. But what I did was in the fall of 1980, I was engaged in an assignment for a bank client. And in that process, I added to this section the idea of a matching employer contribution and a way for employees to be able to put money in out of their own paychecks pre-tax. And Keith, there wasn't anything, in that section of the code saying that you could do either one of those things, but there also wasn't anything there saying thou shalt not. So, I chose to take the more aggressive interpretation.
It began with the opportunity to provide a matching employer contribution. And I think we know over time those things haven't phased out, but have probably been reduced over time, for one thing. An early 401k hurdle was that as these things were new and rolling out, is that plan administrators, they needed the IRS's blessing to reduce employee wages. And in fact, an early name of the 401k was a salary reduction plan, but they had to scrap that name, salary reduction plan, in order to get employees to participate, because that name, salary reduction plan, sounded so unappealing. And I want to ask you more about that later, but is that right?
Absolutely, Keith, because technically someone who is participating in a 401k plan authorizes their employer to reduce their salary and to turn that salary reduction into an employer contribution. That's technically what happens from a tax point of view.
You talked about how a participant in a 401k plan has the advantage because they have pre-tax dollars going into the plan, and then those dollars can grow over time tax-free. And then once one retires, where they must go ahead and take their retirement plan draws between age 59 and a half and 70 and a half, they can pay the lower marginal income tax rate down the road. So they might have had to pay a 32% marginal income tax rate today, but they don't have to pay that. That's deferred. Their money compounds and grows tax-free. And then when they retire, they might be at a lower marginal income tax rate because they're not earning income from their day job. Now they're retired, so they might only have to pay a 22% rate coming out, where they would have had to pay a 32% rate going in. So just tell us about some more of the benefits of a 401k, just for those that aren't familiar with it.
Keith, actually, the greatest benefit of 401k I've learned over the years in talking to participants is the fact that it successfully turns spenders into savers by making saving the first priority. And for most of us, including me, we just don't have the discipline to do that on our own. So, I've had many participants tell me I would have never accumulated the amount that I have in my 401k. And that's really the biggest benefit that it is.
Although I'm not a fan of the 401k personally, I do think that it is of benefit to a certain person. I think a 401k could benefit a person that just is inclined to potentially be reckless or not inclined to learn about finances. The type of person that might want to take their expendable income and bet it all on a New York Jets regular season football game, or bet half of their expendable income on Pennsylvania lottery tickets or something, the 401k plan could actually be a good thing for that type of person that would otherwise be reckless or undisciplined.
Yeah, I think a key point here, Keith, it's really a benefit primarily to people who earn between $30 and maybe $150,000. It's of little benefit to those of higher income above that. And of course, people who are lower paid, they just can't afford to do it. But it's a great program for middle income Americans. And most of them need a program like this to help them accumulate savings for the future, whether it's for retirement or otherwise.
Now, I think a person would readily understand that a 401k doesn't work very well for someone that makes less than 30K per year because, like you said, they just don't really have the expendable income to contribute to it. Why do you think it doesn't work very well for someone that makes more than about 150K?
Well, Keith, I'll center in here on senior execs in big companies. That's kind of the extreme end of the spectrum. But hey, look, putting $25,000 or whatever into the 401k plan, if I were Bill Gates or, CEO of a major company, it's chimp money, okay? Their big payoffs are through stock option programs and, non-qualified plans that give them tens to hundreds of millions and more, as payoffs.
Well, we've talked about a few of the benefits of a 401k. It might get someone to save that would otherwise be inclined to just go ahead and waste the money or do something profligate or reckless with it. And you do have that benefit of a small tax advantage and the benefit of tax deferral. So there are some benefits. What are some of the drawbacks of the 401k with what it has evolved into today from where it began?
The biggest issue in that regard are fees. And I've documented that in a new book I have coming out of the history of fees and how we've gotten where we are. And it isn't a pretty picture. Many employers haven't handled their responsibility well. And the financial community has definitely loaded this up with a lot of unnecessary fees. And just to make a simple statement here, to kind of create a picture, there are over 500,000 401k plans. And most of them have financial advisors who help employers pick the funds that are going to be offered to employees and then help participants make their decision. That process happens over 500,000 times, all right? And as you probably know, the portfolios that these people put together are pretty much the same. I mean, there's no huge differences between them. But each time these folks are getting paid is that they were building a new Taj Mahal, some creative new menu of funds. And it's pretty much just cranking out the same thing over and over again and getting paid as if they're doing original work.
Well, let's drill down on fees somewhat. I often say that 401k, stocks, bonds, and mutual funds oftentimes have more drags on their real rate of return than some people realize. When you consider the effects of inflation, emotion, taxes, volatility, and the fees that you mentioned, sometimes you don't really have a positive ROI at all. So tell us more about fees and just the deleterious effect overall that they can have on a participant's rate of return.
Keith, it can take away years of retirement income. And I have a small employer recently that I helped move from their 401k to one of the models in the guide I have out for small employers. And, that eliminated over $1,500 a year of employer fees, but it reduced participants' costs from 2.75% a year to 0.15%. I mean, it makes a gigantic difference to participants, in the years ahead.
So those 2% plus fees, where were they coming from, or how were they itemized?
Well, they were coming directly from the participants and eating right into their return. And, they were in a traditional 401k, you have a third-party administrator, you have an advisor, you have the mutual fund companies, et cetera. With these simpler models, you eliminate all that baggage and all that cost.
And some people don't understand when it's compounded, say the difference between an 8% return, and if you're paying 2.5% fees, a 5.5% return is just so substantial over time.
Keith, exactly. Over 30 years, it's probably at least 50% more money if you run through the math on it. I mean, it's gigantic. Hey, there's one thing I tell people. There's one sure way to improve investment return, and that's reduce the cost of investing. That's a guaranteed way, of increasing your return.
That is a guaranteed ROI. I think here's the interesting thing, Ted. Let me know what you think, but 401k plans have become so popular and so well known, and whether it's through conventional wisdom or belief systems that have held up for decades now or whatever, it can be attractive for a small employer to tell prospective employees when they're trying to hire them that we have a 401k plan rather than some other plan that they've never heard of. People actually think that the 401ks are of benefit, or they believe some of these antiquated things like, well, it's going to make me a millionaire. But I mean, look at what $1 million is going to be worth 30 years from now. At a 4% inflation rate, it's only going to be worth $308K. People just still have this connotation with, if a 401k is offered, that's a good thing. Should that really be perceived as a good thing and something that can attract prospective employees to an employer that's hiring?
That's exactly what I'm stressing in this guide. Yes, having a plan that competes with a 401k does give an employer a competitive advantage. What I've done in this guide is I've actually used 3 designs that enable employers to mirror a 401k, but without the cost, complexity, or liability exposure. And, the cover of the guide has ducks on it, by the way. There are a couple reasons for that, but I'll give you the second one. Second one is, if it looks like a duck, acts like a duck, and quacks like a duck, it must be a duck.
Yeah.
So what I'm suggesting to employers, and explain how to do that in the guide, is how to present your plan to employees like an employer that has a 401k plan. I mean, most businesses that have 401ks don't actually use 401k in the name of the plan. They'll call it Joe and Bob's machine shop savings plan or retirement plan or whatever, okay? Well, it's packaging, and that's significant. So I call these things Benna 401k, just to put a name around them. But, you can package them the same way to your employees that a traditional 401k is packaged. It's all about marketing.
Well, I'm going to ask Ted more about 401ks, including who does he think that 401ks actually enrich more, the financial industry or the individual saver? You're listening to Get Rich Education. Our guest is the father of the 401k, Ted Benna. More when we come back. I'm your host, Keith Weinhold.
Are you looking for a roadmap to financial freedom? If so, we have a solution for you. Norada Real Estate is offering a limited number of free strategy sessions to help you get out of the rat race. Learn how you can create wealth and build monthly passive income. To set up a time with one of our knowledgeable investment counselors, simply go to noradarealestate.com. That's NORADA realestate.com.
For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com.
Hey, this is Dr. Buck Joffrey, host of Wealth Formula Podcast. You are listening to the powerful Get Rich Education with Keith Weinhold. Don't quit your daydream.
Welcome back to Get Rich Education. We've got a really unique guest today because we're talking with the father, the inventor of the 401k savings plan that helped discover the plan back decades ago and really helped transform this little-known IRS subsection into a household name. You can learn more about Ted at Benna401k.com. That's Benna 401k.com. Ted, you've been quoted as saying that problem with what 401ks have become today with where they began is that 401ks now offer too many investing options, just too many opportunities to make mistakes. You've said you would blow up the system and restart with something totally different. And really that blowing up the existing structures is the only way that we can simplify them. So tell us more about that.
It's kind of too complicated to get into a lot of detail on it, Keith, but the initial 401ks had two investment options. That was it. And you split your money in 25% multiples. 0, 100, 75, 25, 50, 50, 25, 75, or 0, 100. Took less than a minute to explain investments. It was simple and it worked. Then it grew to 3 funds and 5 to 7, 10 to 12, and 25 to 50 or whatever. Just way too complicated for the average participants to deal with. And it doesn't need to be that way.
Now, some people might say, well, there are more options now in my 401k plan than the two that you used to be. Isn't that a good thing?
Well, it is for the investment community, because what happened when you got to 10, 12, 15 funds, the investment community realized, hey, employers need some professional help pick those funds. That was when the investment community really jumped into this thing, Keith, and we saw stockbrokers and insurance agents all of a sudden become investment advisors.
So with the increasing complexity, that gave the mainstream Wall Street financial industry a reason to come in and say, hey, Mr. Everyday Employee, I need to come in and hold your hand and walk you through this because there's more than just two choices here.
Well, and it started actually back with the employer, hitting the employers over the head of saying, you need professional help to help us put these menus together and track and monitor the funds, et cetera, et cetera.
So really with how you conceived the 401k as working originally decades ago, that's just not where we're at today. It has changed so much, and it's been diluted so substantially with fees and laden with other complexities and problems that I don't want to put words in your mouth, but I think you're telling me that it just doesn't serve a lot of people the way that it was intended to. Tell me what you think.
One of the issues here, Keith, is when we went back to the beginning, another important difference was all of the fees other than the pure raw investment fee was paid by the employer. The administrative fees, legal fees, audit fees, etc. We moved, early 80s, we started to move what was called bundling, and everything got bundled together. What really got bundled together were the fees, and the fees all got transferred to the participants to pay. And the thing that makes absolutely no sense to most small employers here is that the people who have the biggest account balances, who are they, Keith? The owners, top people, right? In a 10-employee company. So they would be a lot better off if these fees were transferred back to the employer, paying them, getting the tax deduction for the fees, rather than coming out of their retirement accounts, from tax-sheltered money. It makes no sense to the owners and the senior people in companies, particularly in the small end of the market.
So these changes have been pretty incremental. They're not necessarily splashy in making big headlines in the news when more of the fees get transferred from employer over to employee, and when more of the responsibility for one's retirement gets transferred from employer onto employee. So 401ks have really helped facilitate our move away from the pension. The pension basically being a defined benefit plan where your retirement benefits are strictly defined, and we've changed to a defined contribution plan where your retirement is based on the contributions that you have made yourself over time.
Keith, I mentioned here that I have covered in the book I have coming out the reasons for the demise of the defined benefit system. I started in that side of the business, so I know it pretty well. But let me just make a comment here that's key, and that is the fact that participants in defined benefit plans, whether it's Social Security, state or local government, or private employers, have as much investment risk as they do in their 401k plan. They just don't know it. And I've explained in detail again in the book why in any of these plans you should think hard about getting your money out sooner rather than later.
That means a lot coming from the father of the 401k. So then really when it comes down to it, with where we're at today, who do you think the 401ks enrich more? Do they enrich the financial industry and Wall Street financial advisors more, or the individual saver that's actually participating?
I don't think I can answer the more issue of that, but let me just say that 401k has helped millions of individuals accumulate over $10 trillion of savings. That's a big deal. So certainly it's greatly benefited participants. Unfortunately, it's benefited Wall Street to a much greater extent than it should have. The mutual fund industry, to pick on them specifically, they were mom and pop businesses, a few relatively small mutual fund companies before 401k. 401k made that industry what it is today.
That turned everyday people into de facto Wall Street investors.
Absolutely, whether good or bad.
Well, why don't I tell you about sort of what we do here at Get Rich Education? It's not conventional, but you know what? Having financial freedom and building wealth isn't conventional either. Rather than investing in vehicles that take money out of our pocket every month, like conventional retirement plans, we participate in what I would call a salary increase plan rather than a salary reduction plan. So we buy cash flowing real estate. Therefore, the fluctuating capital value of the asset over time really doesn't matter that much. And we also emphasize purchasing in geographic markets that have relatively stable pricing. Typically, they're in the Midwest and South. So from a capital appreciation perspective, they just kind of plod along. They're actually pretty boring, and you don't see these high highs and low lows with capital real estate prices like you do on the coast. When we focus on cash flowing investments in the Midwest and South, when you have leverage over the long term, it typically appreciates better than stocks and mutual funds. In this real estate, it also has better tax advantages than conventional retirement plans, including the fact that you have the ability to pay zero capital gains tax. And it's really just pretty understandable, and it's something that you have substantial control over. So any thoughts on cash flowing real estate when it's purchased that way in markets like that?
Hey, Keith, I'm all in favor. My biggest asset right now is real estate, commercial and rental properties. No question, it's a good place to consider being. You said, well, why in the world would I be doing that? Well, for 401k, because it was a fluke, was never intended to provide an adequate level of retirement income. So even if you're in a 401k and it's going reasonably well for you, there's still other things you should be thinking about doing. Otherwise, you face the issue of watching your nest egg run dry if that's the only thing you have working for you. So you should definitely be looking for alternative ways, either totally or at least in addition to something like a 401k.
Well, that means a lot coming from the father of the 401k. I had no idea until now that you are a real estate investor as well.
Well, as a matter of fact, this morning I was painting at one of the two rental houses. I have an old farm we have up the road, Keith. So, yeah, I like that physical element of it as well. So that's a plus for me.
That investment is easy to understand, easy to control, and it is improvable as well. That's really part of the control that you've got there. So what does the father of the 401k actually do today?
Two things I'm working primarily on now is the guide I've mentioned a couple of times. It's out there to help tiny employers that don't offer a plan to their participants, an alternative that, like I said, doesn't have all the cost, complexity, liability exposure of a traditional 401k. And then the other is getting this new book, which will be my fifth one, out and on the market. The title of it is 401k 40 Years Later.
Yeah, that's great. And where can someone learn more about you and your books and everything that you're doing today?
Well, my website is www.benna, BENNA, 401k.com.
Well, Ted Benna, you have had a substantial impact on millions of Americans, sometimes for better, sometimes for worse, but your impact is very deep. What you've helped create is a household name today. Thanks so much for coming onto the show.
Keith, thank you for having me on. I greatly appreciate it.
Yeah, that's so totally interesting that Ted Benna's biggest asset is real estate. That was great to hear directly from the inventor of 401ks, that if a 401k is all that you've got, you should not expect that to provide an adequate level of retirement income. That comes from him. 401ks, they might be good for the gambling degenerate. The gambling degenerate putting half of his discretionary income on a roulette wheel, or those not inclined to care about their finances, or really then their quality of life. My point is care. That's why I'm here. Your life can be so much better than you think when you care and invest for income rather than speculative and diluted gains. Now, I think you do have to acknowledge that Ted has made a positive, substantial contribution to a certain subset of people that are not financially inclined to invest or care. But that person is not you, or else you wouldn't be listening. And plans have evolved substantially beyond what he ever intended. And what else have the plans evolved into? Well, many employers now have auto enrollment, meaning that you have to intentionally opt out and take a specific action if you don't want to participate in the plans. If you have a dollar per dollar employer match with your plan, something that keeps getting phased away over time but not phased out, well, then you have to decide if it's worth your participation only up to that level or not. Ted might be able to help you if you are an employer and you want to offer a retirement plan alternative to your employees, something other than the 401k. Now, if you are an employee, it's really not your employer's job to educate you on finances or tell you that cash flow in real estate is the way. It's not their job at all. It's yours, and it's also mine for you right here. And Ted Benna ended up inviting me over to his place because coincidentally, he lives in upstate Pennsylvania, which is where I was born and raised. So I might stop by and chat with him on my next visit back there. Who knows? Maybe Ted and I will discuss how the return from home equity is always zero. We'll see. In any case, thanks to the inventor of the 401k, Ted Benna, today. Coming up on the show here, if you've cracked equity out of your home with a home equity line of credit, well, what's another bad thing that can happen to you other than the fact that your interest rate can float up? Yes, there is more. I've had it happen to me about 10 years ago. I'll tell you about that. A demographer is also coming back onto the show to tell us about real estate trends and where your best places to invest in real estate are going to be over the coming years. Well, where do you actually find these best properties where the numbers work in investor advantage places and you can get passive income? Well, I'll tell you, here at Get Rich Education is where you get the education, and GREturnkey.com is where you can connect with providers to find the properties. GRE stands for Get Rich Education. So if you haven't, check out GREturnkey.com. If you just make enough effort to connect with a provider there and maybe even make a quick phone call and build a bit of a relationship, you can land some cash flowing property. That starts again at greturnkey.com. Thanks to Ted Benna today. I'll be back next week to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. And I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's bradsumrock.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.